Hey, and
Hello?
hit
Hello?
recording.
Hi, everyone. Yes, it is working. Hooray, we
We've
did
got
it.
people here.
Hello, I see
I see
John, I see
Chad,
Liz,
Dave,
Khalid, Frank,
Elias,
Dave,
there's
Chad.
Ryan,
Hi, everybody. Thank
Sid.
you all so much for joining us today. Welcome, 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 and happy Friday. Happy Cinco de Mayo.
Cinco de Mayo, that's right. And yesterday was May the 4th be with you. It was Star Wars Day as well.
Rhode Island Independence Day, as we've already talked about.
And tomorrow, my wife's birthday. The
Oh,
most
even
important
more
one out of all
important.
three of those.
That's right. You doing anything for Cinco de Mayo?
No, preparing for my wife's birthday is what I'm doing for Cinco de Mayo.
That's worth it. By the way, if you are married and you have kids, friendly reminder that Mother's Day is like a week away or 2
A
weeks
week or
away.
two. I think we've got an extra week. It's always hard for me because I've got the birthday and the Mother's Day, right?
Yes,
Like
they're back to back.
oof.
I was on Etsy this morning trying to find something. Etsy's always my go-to, and I was scrolling through, and I was like, I've bought all these things already, so I need ideas. I need ideas. Yes, yeah. Hello, yes, everybody. So we have a chat that is going on, but we would encourage you. If you have questions for us, use actually the Q&A tab. There should be a Q&A
Yep.
tab down below. The reason we encourage you to use that is because you can actually upvote questions that you see. So the questions that get the most upvote will go to the top, and we will be sure that we can answer them. Hello, Chicago.
But I do
see.
love
Jen,
people sharing where they're at. Jen's in
totally.
Chicago.
Totally.
And
Yep.
I'm not far from you. I'm in Milwaukee right now.
Yep. And I am in lovely Rhode Island. We have Italy, Calgary. Awesome. International. Love seeing the international group.
Denmark.
Denmark. Love seeing the international interest in financial statements. So thanks everyone for going in the chat, but you should also have a Q&A session. Please make sure you use the Q&A if you have questions for us. That's what we want to do.
That's what we're going to monitor too
Totally.
for questions as we're going through.
Yeah, absolutely. So thanks everybody. We are here to talk accounting. This is an introduction to the financial statements. And we have, Brian, let's just get going, shall we?
Yeah, let's get started. Also, UAE, we are all over the globe.
So quick introductions. My name is Brian Feraldi. I'm an author. I've been investing for about 20 years. I've been classically trained. I have an MBA in finance, but I am obsessed with all things money and investing. And it is my absolute favorite thing to help other people demystify finance and investing in the stock market.
And my name is Brian Stoffel. I was a middle school teacher, and I'm not classically trained. You could say I have the street smarts. I had to learn through making my own mistakes. After teaching, I became a writer for The Motley Fool. I've been investing for 13 years. And this scratches that teaching itch that I've always had. So this is one of my favorite parts of doing what we do.
So first, let's answer this question. Why on earth does learning accounting, a boring topic, a seemingly boring topic, matter? Well, we can think of three ways that this can improve your life. First and foremost, accounting is the language of business. And no matter what kind of career you have, you are dependent on business for giving you income in some way or another. So if you don't know how to read financial statements, it's kind of like being surrounded by a world full of musicians and not knowing how to read music. So it's a really important skill to learn.
Yeah, I love that metaphor, that analogy. Number two is to become a better investor. And we know that that is probably how many of you ended up here at this class. That's what we focus on our social channels. So if you want to become a better investor, understanding these statements is required.
Yeah, for sure. And then third, we think that understanding financial statements can help you in your own career. If you're an entrepreneur, if you're a business owner, if you have a side hustle buying businesses or anything like that, learning these financial statements is critical. But I actually believe if you are a manager at an organization, if you can show your employer that you understand financial statements, that puts you on the fast track to the C-suite if that interests you.
Yep. And so when I was a teacher, every day on the board, I had to write IWBAT, which means my students will be able to do something by the end of this. And we do the same thing when we have our teaching sessions and webinars. So our goal for this webinar that we're doing today is that everyone who's attending will be able to identify the three financial statements and know what information each one relates. If you know how to do those three things at the end of this, we consider that a success.
Yeah, for sure. So here is a quick overview of what we're going to be covering in this webinar. We're going to be starting with an overview of the financial statements. Then we're going to dive into each of them for about 5 minutes, talk about the specific parts of them. Then we're going to cover a confusing topic, which is GAAP and non-GAAP, what those words means. We're going to show you how to find the financial statements. Finally, we're going to end with Walmart as an example. We're going to show you how to find Walmart's financial statements and do some quick analysis of it. Then we're going to end with a quick Q&A on our upcoming financial statements course. So if that interests you, hang out to the end.
Sinha, if you would care to take notes, you are welcome to, but they're not required. We will be mailing out a copy of this presentation, a copy of this recording at the end of it. So know that you will have a chance to go back and look at it. But let's review what these 3 financial statements are that we're talking about. Number 1 is the balance sheet. Number 2, probably the most people are familiar with, is the income statement. And number 3, probably least appreciated, is the cash flow statement.
So if you've heard these terms before, but you don't know what they mean, we have good news. You are actually more familiar with these statements than you probably realize. And that is because you actually interact with these statements in your own way in your personal life. So here is what the balance sheet looks like. And whenever you hear the word balance sheet, just substitute in your mind net worth statement. It's simply a measure of a company's net worth. That's all a balance sheet is.
Income statement, this is very similar, a proxy for your monthly budget. You have your income that you get from your job, and then you have to subtract all of your expenses, and you're left with your savings rate at the end of the month.
Now, the third one is probably the hardest to understand, and that is the cash flow statement or statement of cash flows. But believe it or not, we actually think you do interact with this statement in your real life too. If you have a checking account or a savings account, that's really what a cash flow statement is. And that does differ from an income statement, as we're about to show you.
Now, importantly, all 3 of these statements can stand on their own, which means you could look at them in isolation and find out something important about a company. But importantly, the real benefit comes when you understand how they interact with each other. And when you can combine all 3 and know how one affects the other, that's where you get the quickest, most full picture of a company.
Okay. So let's take a closer look at each of the 3 statements in more detail, and we're going to start with the balance sheet. Now, if I was to ask you, what is your personal net worth? You would do some math in your head. You would say, well, here's what I own, and I would subtract from that what I owe, aka my liabilities. And the difference between those 2 would be your net worth.
Well, with a company, we follow the same blueprint. You take everything that the company owns, their assets, subtract out everything they owe, their liabilities, except because we like to make things confusing, instead of calling that the company's net worth, we come up with some fancy schmancy words like shareholders' equity, but know that it means the same thing.
That's right. However, while this is the formula that you have in your head, assets minus liabilities equals that net worth, the way accounting works is it takes that liabilities and it throws it on the other side of the equation. So here is the master balance sheet equation. Assets equals liabilities plus shareholders' equity. It's the exact same calculation as this, just with liabilities on the other side of the ledger.
Now, we're not going to go through every single line item, but the basics here is to know that you have everything the company owns on one side, and you've got everything that they owe plus that net worth, and they balance each other out. Why it's called a balance sheet.
Right. These 2 numbers, the assets and the liabilities and equities, always are perfectly matching each other. Now, the balance sheet, the left side of the balance sheet, the assets, is broken out into 2 main categories. The first category is called current assets. The word current just means that it's expected to be used in some way within the next 12 months. So if you have cash, which would be a current asset, that would be something that the company would be expected to use within the next year. So that's all that the word current means.
And then underneath it, you see long-term assets. Those are assets that are expected to be used over a much longer period than the next year. Your house or your retirement account would be great examples of this. You have them and you expect them to be around for much longer than the next 12 months.
Now, over on the liability side of the equation, the numbers are split out in the exact same manner. There are two types, broad categories of liabilities. The first is current liabilities, and those are bills that the company is expected to pay off in the next 1 year. Any bill that's due within less than 1 year is a current liability.
Long-term liabilities are beyond that, and those are bills that you're going to pay beyond the next year. Again, your house is a great example because your mortgage, whether it's a 15 or a 30-year mortgage, is a great example of a long-term liability that you expect to be there for more than a year.
Now, the final category is called shareholders' equity. There are some wonky accounting terms in there, but when you add them all together, they essentially give you what is a company's net worth on paper.
So a really important thing to know about the balance sheet, because this is unique to the balance sheet, is that it is a snapshot. It is a point in time. And this makes sense. I have stocks that I own in the stock market. And so my balance sheet changes every second as the stocks that I own change price. So this is just a snapshot on a particular day.
Now, balance sheets work best when you have multiple of them lined up in a row so that you can see how a company's net worth is changing and evolving over time. So when companies are presenting their balance sheet to you, they're typically doing it in comparison to another snapshot from the past.
Now, usually when companies report, you're going to see their balance sheet on a quarter by quarter basis, and they'll oftentimes compare it to wherever it was at the end of the fiscal year. The quarterly ones are called 10Qs. The annual report is called a 10K.
Okay, so that is a little bit about the balance sheet and how the balance sheet works. Now let's move over to the income statement. And this is akin to asking somebody, what is your monthly budget? What is your annual budget? Well, the math there is super simple. How much money did I make? That would be my income from working and interest, etc. I had a whole bunch of expenses, my house, my car, etc. And the difference between those two would be how much money I saved or had left over after I paid for my expenses.
Now, with companies, it's the exact same idea. You take all the income, as we call it revenue now, and we subtract out all the expenses involved with running the business. And then instead of a savings rate, you're left with a profit or a loss, sometimes referred to as a P&L.
Now, while the balance sheet is just a picture, it's a snapshot, it's a moment in time, the income statement is more like a movie. There's a start time and there's an end time to it. And income statements are typically have a start time of a measure that's measured in quarters or even years. So for example, you could say, how much income did I make? How much revenue did I make between October 1st and December 31st? And what were all my expenses during that same period?
So let's look at what's in the income statement. And when we start out, we would be remiss to not point out that looking at the time period is really important, because some companies list the most recent time on the left and some do it on the right. And if you make that very simple mistake, it can really throw everything off.
So the first number, the top line of the income statement, is how much sales, aka revenue, you generated during the period. It is the total value of all products and services sold during that specific time period.
Next, you have to take out expenditures, and that's everything from manufacturing, whatever you're selling, your operating expenses, like your overhead costs. If you owe any interest because you took a loan from the bank, and the taxes that you might owe, you subtract all of those in these different red sections.
Now, the bottom line of the income statement is called net income, which is a word that is synonymous with the words profits and earnings. Net income, profits, earnings all mean the same things. Did you generate a profit during this specific period?
Now, if this was just your family budget, that's where it would end. We wouldn't do anything else. But because we're talking about publicly traded companies, there are two more items. And the first is looking at the total number of shares outstanding.
So in Apple's case, let's take a look at Apple, which just reported earnings yesterday as it would have it. Apple made tens of billions in dollars in profits. I actually don't know the exact number, but Apple has 16.8 billion shares of its stock outstanding. So there are literally 16.8 billion claims, equal claims on that company's profits.
And so when you take those profits and you divide it by the number of claims that people have to that profits, you get the profit per share or earnings per share or EPS, which all mean the same thing.
Now, it's important to note that the income statement uses a method of accounting that is very important, and that is called accrual accounting. This is a key thing to understand about the income statement.
So here's what that funky word accrual accounting means. It means that any revenue that you generate or expenses that you incur, we record them whenever they occur. So whenever you use the thing, not when the payment is made or received. So you record income when you earn it, not necessarily when it arrives in your bank account, and you record an expense when you use something, not necessarily when you pay for it.
So to drill down what this actually means, let's think through the process of buying a brand new car. Let's say that we go to the dealer and we buy a brand new car for $33,000 in cash. We expect to drive that car for 10 years. And after 10 years, we're going to sell that used car and we expect to get about $3,000 for it.
So here's what it feels like to actually own that car, not maintain it. We know there's costs involved with it, but you lose $33,000 in year one, and you expect to recoup 3,000 of those dollars at the end of year 10. This is what happens in real life.
Now, according to accrual accounting, remember the key thing about accrual accounting is that revenue and expenses are recorded when they occur, not when the payment is made. So we expect to use this car for 10 years. So accrual accounting takes that lumpiness of the outflow and inflow of cash, and it smooths it out so we can actually determine how much we spent on that car during a specific period.
So how would you do that? Well, you take your $33,000 you're spending and you subtract out those 3,000 you'll get back, divide it by 10 years. And according to accrual accounting, instead of that lumpy one-time payment at the beginning, we have to assume that we are paying $3,000 every year to drive and own that car. So accrual accounting says, hey, this is what it looks like. Even though that's not what happens in real life, that's how it shows up on an income statement.
Now, how we would account for that specific expense is with a fancy term called depreciation. So each and every year that we owned that car, on our business's income statement, we would subtract $3,000 in depreciation expense for that vehicle. So that's a little bit about how accrual accounting works, and it's a critical thing to understand if you're going to be analyzing and understanding an income statement.
And why is accrual accounting so critical? Because it will inform the basis for the difference between the income statement and our last one that we're going to cover, which is the statement of cash flows or the cash flow statement.
Now, the cash flow statement is very similar to the income statement. It measures cash movements in a business over a period of time. So again, a balance sheet is a snapshot, a point in time. The income statement and cash flow statement are measured over periods of time. There's a start and there's an end to it.
As we said, this is what the cash flow statement looks like, but it is like changes in your bank account. So you might buy a whole bunch of things on your credit card, but if you haven't paid for that credit card by the end of the statement, that would not show up in the cash flow statement.
Now, the cash flow statement is broken out into three main categories. Category number one is operating activities. This is all cash that changes hands as a result of directly operating and running the business.
Number two is investing activities. That is all cash that changes hands because of investments that are made. Now, those investments could be acquisitions, those investments could be investments in companies, but those investments can also be investments in property, plant, or equipment, physical things that you are buying so that your business can run.
Now, the final way that the cash flow the final category is what's called financing activities. And what this is measuring is how you are financing that business. Are you using it by selling stock? Are you borrowing money from the bank by paying off debt? Are you repurchasing that stock, or are you paying dividends? That's where those activities would be recorded.
Now, if we haven't hammered this home yet, the cash flow statement is so critically different than the income statement because it uses cash accounting, which means here transactions are recorded only when the money goes into or out of an account in the bank.
So to review the difference, cash accounting is when money actually trades hands. The money leaves your bank account and goes to a supplier or customer. And the same thing for expenses. The only thing cash accounting cares about is, did cash change hands?
And the only thing accrual accounting cares about is, was a good or a service rendered or not? If it was, it counts as revenue or as an expense.
So to visualize these two, let's think back to that car example. Cash accounting would be this. Cash accounting would be the money leaving your bank account when you bought it, and money coming back into your bank account when you sold that car.
But accrual accounting, which is what the net income statement uses, smooths everything out over the life of however long you're using that product. So even though this isn't what actually happens over those 10 years, this is how your own personal income statement would reflect that purchase.
Now, one thing that's interesting to note, remember before we said that the income statement and the cash flow statement are very similar. Well, they are so similar, in fact, that they share a single number. The very bottom number of the income statement is called net income. That's that profit. That number is quite literally the very first number, the top number of the cash flow statement. So it just shows how these statements are interrelated with each other.
So we know that profits are what comes at the top of the cash flow statement. So what else happens? Well, first, we add in cash that didn't actually flow out. In other words, those $3,000, they didn't leave your account in your third year of owning the car. So you add that back in.
Then we have to account for money that came into us that wasn't that came from other sources. Perhaps we sold an investment. Perhaps we issued debt, which raised cash. Perhaps we issued stock. On the cash flow statement, we would see those movements taking place.
We'd also have to subtract cash that actually did flow out, even though it wasn't accounted for in the net income statement. For instance, in year one of buying that car, this is where that $33,000 leaving your account would be accounted for.
Now, finally, after you do all of that addition and subtraction up and down, what we get at the bottom is how cash changed hands during this specific period, and we're left with how much cash is in our bank account at the end of that period.
Now, we just showed you how the income statement and the cash flow statement speak to each other. Here's how the cash flow statement speaks to the balance sheet. We see the cash at the end of the period is the bottom of the cash flow statement, and that then scoots over and is reflected at the very top of the balance sheet.
Okay, we just threw a lot of information at you, so let's review each statement again. The balance sheet, its purpose is to show what a company owns and what a company owes. It's very similar to your net worth statement. It uses a point in time. It's a picture. It's a snapshot, and it uses accrual accounting.
Number two, the income statement. Its purpose is to track income and expenses, and it's similar to your monthly budget. Unlike the balance sheet, it covers a period of time, usually 3 months or 1 year, and it also uses accrual accounting.
The final statement, probably our favorite of the three, is the cash flow statement. The purpose is to track cash flow, cash movement. It's very similar to looking at your bank account, the checking account. is measured over a period of time, and it uses cash accounting. That's the key difference between them.
Now, we're about 20 minutes in. We're actually right on schedule because we want to show you we're almost done now. We're just going to talk about these funky things called GAAP and non-GAAP accounting and show you where to find these statements.
Yeah, so A+ job if you're still paying attention. We super appreciate it. So let's move over to a rather confusing topic that you may have heard: GAAP, GAAP, and non-GAAP. What on earth do these terms mean?
Well, GAAP stands for Generally Accepted Accounting Principles. And what it basically means is it's a common set of accounting principles, standards, and procedures that US publicly traded companies must follow in their financial statements. There's no maybe, it's must.
So when you think about it, it would be chaos if all different companies used their own accounting standards. So GAAP is a generalized a number of assumptions related to accounting that all companies have to follow. And because all companies have to follow, they are verifiable. It makes reporting from one company to another the same. It makes them neutral, and it's very easy for investors to compare one company to another. So GAAP is the accounting standard that we use in the United States.
However, it's important to know that these GAAP accounting standards, while they are flexible, they can change over time. They were created during the old economy where manufacturing was the main way that products were produced. And so GAAP makes a lot of sense for manufacturers. However, in today's economy, focused on technology, software, things like that, it makes less sense.
So since GAAP is very black and white, there are certain standards for it. It doesn't always apply to modern day companies. So because of that limitation in the way that companies today operate, it's given birth to an alternative way of measuring profitabilities that is called non-GAAP accounting.
That's right. And as you might expect, that just stands for non-generally accepted accounting principles. Now, what does this mean? Well, it basically gives management teams the flexibility to exclude one-time transactions that don't really reflect the state of a business.
So GAAP accounting is black and white, uniform. Every company has to do it. Non-GAAP accounting gives management teams much more flexibility with how they report and measure things. Now, that can make sense in some cases, but when you give management teams flexibility, it also can create its own set of issues.
That's right. So let's consider why this is important to have not one or the other, but both. Let's say you sold your home and you made a couple $100,000 on it because you've been holding it. The market has gone up. According to GAAP accounting, you would have to count whatever profit you made as income for that year. But would that really make sense if your accountant said, well, how much money do you make in an average year? You wouldn't have your salary plus whatever you made for that house because you know that that's not something you're going to do every year. Non-GAAP metrics allow you to exclude that and say, well, yeah, okay, I made that money this year, but we all know that that's not a recurring thing.
So GAAP accounting, black and white, everything has to be included in there without exception.
Non-GAAP, it gives you color and it adds color to the picture. It lets you get a more holistic picture of where a company is at and how it's doing.
Now, there are a number of companies that report both GAAP, which they're required to, and non-GAAP earnings. And if you think about why they do that, well, GAAP accounting is auditable, it's standardized. You have to include non-recurring charges, you have to include stock-based compensation, and you have to include paper losses and gains on your investments. Because of those rules, those black and white rules, profits, the amount of profit a company is producing under GAAP accounting tends to look much worse than non-GAAP accounting.
That's right. When you use non-GAAP accounting, you can exclude a lot of those one-time items, especially the stock-based compensation, but also any type of restructuring charges. You've heard about a whole bunch of tech companies doing this year because there's lots of layoffs. In non-GAAP accounting, they don't include that, and it makes their profits look better.
Right. So that is the difference between GAAP and non-GAAP. Most companies, most newer companies tend to prefer reporting in non-GAAP in addition to give additional color. And we're not here to say that one is always better than the other. It's just important if you're going to be looking at financial statements to understand the difference and know what you're looking at.
So let's talk about finding those financial statements, and we're going to show how to do that using Walmart as an example, and then we'll get to talking about our course and Q&A. So when you're looking for financial statements, there are 3 key ways to do it, and we'll go in order in terms of their accuracy.
So the gold standard way to find financial statements of US companies is to go to the Securities and Exchange Commission's website. This is sec.gov, and I'll show you how to do this to find Walmart's financial statements.
A second way to do that is to go to a company's investor relations page. You just go into your search engine like Google, say type in Walmart Investor Relations, it'll take you to the page, and you can find the financial statements there as well.
The third way to find them is probably the most popular, and that is to use a financial aggregator. These are companies out there that pull in financial statements from hundreds of different sources and make it sortable. These are very popular, and we love using them ourselves. And while there are dozens of them out there, 3 of our personal favorites are Stratosphere.io, a company called Ticker, T-I-K-R, and Yahoo Finance.
So let's just show you how to do that first one, because it's probably the one that's the most technical. Here's how you would find Walmart's financial statements using the SEC's Edgar database.
Right. So SEC Edgar database is what you're going to want to look for. And we have that pull up, and we go to company filings on the left here. Here, we're going to be entering in a ticker symbol. We could also do that right up here too. But in this case, we're going to type in Walmart. And I know that the ticker symbol is right there, WMT, but you can type in any company to this search box and it comes up. Now, this is a government website, so it looks and feels a lot like a government website. But so you can click and unclick this to get some kind of company information about where they are. But what we're going to do is to go over the most recent financial statements. So I'm going to click this tab right here, which says 10K, annual reports, and 10Q, company reports. And notice that the 10K is the top one here. So this is Walmart's annual report, 10K, that was recently reported on January 31st. Now, if I click over to that, I get a massive document that pulls up. But to give you a little shortcut, if you go to this sections tab right up here, it has the main parts of the document. And we're just going to click right here to financial statements. And I'm going to click the top one, which is consolidated statement of income, AKA the income statement. And there we go. Now, I'm going to zoom in on these to see so that you guys can see them a little bit better. But here we go. So Walmart's statement of income for the fiscal year ending January 31st, 2023, 2022, and 2021. Now, right at the top, we have revenue. This is how much revenue Walmart pulled in during these last 3 fiscal years. So you see that Walmart's revenue is actually growing. Right below that is what did it cost the company to create this revenue? Well, here is cost of sales. So that's how much Walmart actually spent on stocking its store shelves. And then here's how much money the company spent on employees, salaries, overhead, buildings, distribution, etc. You subtract all that out, and what we have is how much operating profit Walmart generated for 2021, 2022, and 2023. To go down some more, we see, well, Walmart has a whole bunch of debt that they have to pay interest on. There's what they're paid interest on. There's how much the cash that they held made in interest. So you can see that they have quite a bit of interest expense. We subtract that out. We get Walmart's earnings before taxes, their profits before taxes. Here's how much they paid in taxes. And then here is their consolidated net income, AKA earnings, AKA profits that the company has. And then if we do some quick division, we can see this is how much they earned on a per share basis. So here is their earnings per share.
And then
How I
Brian, you can show them, we don't need to go through each one, but we can show you that this is then you click on the balance sheets and you can find out things like cash and inventories. You find all their assets at the top. If you scroll down, you see all of their long-term assets. Then you see, like we showed you, current liabilities, and then underneath that, long-term liabilities. And underneath that, shareholder equity.
Mhm. And then if we keep scrolling down, I'll get all the way down to their statement of cash flows, aka their cash flow statement. So notice this is their net income. This is their profit at the top for the last 3 years. And then it shows all of the accounting of the cash changes, charges that they recorded during the period. And they finally get this number here, which is a very key number: net cash provided by operating activities. You can see that Walmart's number has been was down over the last couple of years. And then this is how much money they invested in new property, new plants, and new equipment, a number that's gone up over the last couple of years. And this number here minus this number here, it gives us a very common term that's very important to know in accounting, and that is called free cash flow. And you can see how much money, what they've been doing with their cash flow. So Walmart's been paying off debt, it looks like, although they've been issuing new debt. They've been paying a growing dividend. They've been buying back company stock. And then here's how much cash they had at the end of their year. So it looks like they're down to 8.8 billion, even though that number was 17 billion just a couple of years ago. But you can see how just quickly finding and looking at these income statements can tell you a whole lot about Walmart's business. So if you have any questions about what we just did or anything like that, we are happy to answer them next after we transition to the Q&A.
So we just want to explain that if you enjoyed this, if you found this helpful, this is to all kick off and introduce that starting in a few weeks, we will be opening up for the 4th time our live cohort-based course, Financial Statements Explained Simply.
So this is our 4th time doing this course. If you are interested in getting a much deeper dive.
That's right. And I'm going to work real quickly to make sure we get a link to that in the chat right now. I'm going to put that in. So Brian, do you want to just start on the questions real quick?
Yep. So we have lots of questions that we're going to answer one at a time. But before we do that, we've done this many times, so we know what the most common questions are. I'll start with the first one, which was GAAP versus non-GAAP. Which one do we look at when we're analyzing a business? The truthful answer there is it depends on the nature of the business. If it's an old company that's existed for years, it is already profitable. In many cases, we demand looking at GAAP numbers. GAAP is like the gold standard. So if I was analyzing Microsoft or IBM or Coca-Cola or Procter & Gamble or Accenture or companies like that, I would be only caring about the GAAP figures. For newer businesses, for internet businesses, for companies with different cash flow dynamics, I think it's actually more helpful to look at the non-GAAP numbers. But I have trained myself to know when management teams are trying to pull a rug over your head. So I always try and look at both if they're presented, and I kind of average the two to get a truer idea of what kind of financial statements the companies are actually producing.
All right, question number 2, and I have put a link to the course in the chat. So make sure you use the code webinar 299 to get that credit. What are financial statement yellow flags? Well, the yellow flags, it depends on the business, but hopefully by the end of the course, you'll be able to identify where are some issues popping up that I need to know about. For instance, the gross margin is shrinking. That's a yellow flag. We can't dig into what all of them are now because that could take well over an hour. But once you get to know what the different parts of the financial statements are, it's much easier to find those.
Yeah. One big one that I'll throw out there that not many people pay attention to is when net income and free cash flow are completely different things. And we're kind of talk about why that is such a critical thing for investors to look at. Number 3, what are some common mistakes that people make when looking at financial statements? A couple that I can say out now. The first and most important one that we see all the time is they get the dates wrong.
Yeah, we still do.
They look at they look at 2021 thinking it's 2022, and they screw up the dates. That's easy. Another one that I made a mistake early on was I ignored these things called margins, which is measuring profitability on a percentage basis. That's actually really critical. Or how about this one, Brian? People only look at earnings per share and they make
Mm.
all their conclusions based off of earnings per share without understanding the ways that earnings per share can be misleading. So we
Yeah.
cover all of those mistakes in the advanced part of the course, which is week 2.
Yep. Should I pay attention to stock-based compensation? Well, that depends entirely on what type of investor you are and if you understand what it's being used for. Remember, stock-based compensation means employees are being paid with shares of the company they work for instead of cash. The benefit is that the company doesn't have to spend precious resources on paying its employees. The drawback is the fact that shareholders like you and I are diluted. There might be, say, 10 shares, and then all of a sudden there's 12 shares. So I own less of the company as a result. If the company is executing well, usually that's a pretty good trade-off because it gives them flexibility while they're in their embryonic stage. But if the company is not doing a good job of executing, if it's not making things that the world really wants, well, then that ends up not being such a good deal.
Question number 5 is, what about valuation? So valuation and reading financial statements are linked at the hip, and it's really critical to understand how to read financial statements if you want to learn about valuation. We are going to touch upon quickly some of the very simple valuation metrics in the course, but if you have specific questions about that, we are more than happy to answer that in any of the Q&A sessions that we have.
All right, so Brian, I can start at the top, and if you want to start at the bottom, and if you have a question, head on over to the Q&A because we still have 17 minutes till the top of the hour. Access Partners starts and says, how can I generate a cash flow statement from the balance sheet and the income statement? You really can't because there's information that you can only find on the cash flow statement to do that. And I'll also answer David Wu's question, what's the quickest way to identify in financial statement whether a company is making money or a profit? I would say the net income, but also the free cash flow statement. Look for the cash flow statement, look and see if it is generating free cash flow, which we will cover in the class.
Hoodie Peak says, where do employer salaries fit in the income statement? The answer there is in 2 places. The primary places is in operating expenses. That is where the bulk of salaries of a companies go. The only exception to that is for people that are involved in the manufacturing of a product or in the service business, if they're the one actually servicing the product. In some cases, their salaries are reported in cost of goods sold, but the vast majority of the salaries are reported in operating expenses.
Question here from Jen. And Jen, thank you so much. I saw in the chat that you were helping some people out who didn't have access to the Q&A. That's awesome. On behalf of Singha said, how do we place IFRS in this context? So IFRS is like GAAP, but for companies that are outside of the United States. The long and short of it is that both of them include the same guts, but they arrange them somewhat differently. So there's still a cash flow statement, there's still an income statement, there's still a balance sheet. But for instance, the long term might go above the short term, and sometimes the liabilities go above the assets. So the order of things are different, but the guts are still the same.
There's a question from Anonymous, says, what would you guys say is a good resource to look at the business that takes into account all 3 statements? So this one here is rapidly becoming my favorite. I hope I'm sharing the right screen.
Yep.
It's stratosphere.io. Stratosphere.io. This is a free platform, and you can look up any company in the world. And I think that they just do a sensational job about making this data easy to find. They measure out all the margins for you, and you can look at the balance sheet, the cash flow statement, and you get a whole bunch of quick views at the company's metrics. They also have all kinds of charting information that you can do and you can pull up. You can also see things like how has revenue grown over time and done this. And the really cool thing about this platform, it is completely free to use. Personally, I do pay for the premium because I think the premium features are worth it. You can actually use my last name as a discount code, but if you just want a free platform, I think Stratosphere is excellent.
Jen, great question. Jen says, during the course, are we going to get into the why of why things changed in, for instance, Walmart's balance sheet? So Brian, you pointed out they went from $18 billion in cash all the way down to 8. Without any other context, you might start saying, holy moly, Walmart's in trouble. Yes, we will get into that why, because what they're using that cash for is really important. In the case of Walmart, they're buying back a lot of shares of the company. And in general, as long as they're not in trouble of running out of money, shareholders love that.
Question here from GURP saying, can you guys please explain goodwill? Yeah, goodwill is a very confusing term. And to give you the quick overview on it, goodwill is the premium, the excess that one business pays when they acquire another company. So when a company acquires another company, they have to record the excess that they paid for that company's assets as a term called goodwill. So for example, this is Walmart's balance sheet. They report goodwill of $28 billion, meaning if you add up the total premiums that Walmart has paid throughout its entire life to acquire other businesses, that total is currently $28 billion. So it's called goodwill, which sounds like a good thing. In general, that is the worst asset that you can have, in our opinion. There are some companies that do tremendous things with goodwill, but more often than not, goodwill is not a good measure for investors to look at. So it is a critical term for investors to understand, but it can be confusing.
So both Anonymous and Paul asked a similar question, which basically means in this course, assuming that there's a replay, and if so, can you go back and watch? Yes, absolutely. We encourage people to attend live, but we understand that not everybody can. So you will have access to a recording of the class. You will have access to all of the materials, the literal Google Sheets that we draw up for the class. And as a part of the class, you will also have access to 24/7 during the class of a live community where you can go and post homework, post questions, chat with other class members. We host it on a platform called Circle, and we think it's a really powerful way to build community while we're in that class together.
Jen asks, what type of homework is there during the course? So we have homework scheduled out throughout the course, and all of that homework is designed to reinforce the key lessons that were taught during the course. Now, when we're talking about the balance sheet, for example, the homework is twofold. First, we ask you to look up a company that we choose, and we say, highlight the numbers on the balance sheet, fill in this information so that you really get to know the terms. And then second, we're going to ask you to do that same exercise with the company of your choosing. So by the end of the course, you're actually going to become an expert at whatever company that you want, and that will be part of your homework.
Ryan says, I've seen companies report negative earnings per share, but they have positive free cash flow. How does that work? Great question. There's two big things happening here. The first one is that stock-based compensation is included in earnings per share, but not in free cash flow. Because again, the company actually isn't paying any money. You're getting diluted as a shareholder. So that's one way, because that's a huge expense that shows up on the income statement, but is not reflected in any real life changes in the balance sheet. The other is that a lot of companies, especially software companies, if you think about how the business works, they get paid at the beginning of a period, and then they provide that service over the next 3 months or the next year or the next 5 years. And on the income statement, you can only record that as revenue as you provide the service, but the money's in the bank. So that's how that happens.
Anonymous, I'll take two questions, Brian, real fast. Anonymous says, do SEC 10Qs and 10Ks both have GAAP and non-GAAP statements? They all have GAAP statements. Only some of them have non-GAAP. Non-GAAP is an optional way of presenting the numbers that some management teams choose to do. So those that do tend to report them in their SEC filings, much more commonly in their investor presentations and their press releases. So all of them have GAAP, only some of them have non-GAAP. Second question is from John. Brian's, can potential investors trust a company's quarterly financial statements? The answer there is, if you can't trust the numbers, don't invest, period. However, companies that are publicly traded are audited, and in the wake of Sarbanes-Oxley and the auditing things that we go through, there are stiff penalties and potentially jail time with fudging the numbers. So people that actually fudge the numbers are far less common today due to regulations. That doesn't mean that it doesn't happen. But in general, companies that are reported on public exchanges, especially big, well-known ones, you can trust the numbers.
So Stefan asks a little bit more deeper question here, which is what do we think about convertible bonds and the possibility of diluting existing shareholders? And I think what you're talking about is basically convertible senior notes. It can either be repaid or it can be turned into ownership of a company. In general, you have to look at the levels, right? Because the details matter. But what we like about convertible senior notes is the fact that they can be used and paid off as debt, or they can be used and paid off with stock. And that flexibility can be a good thing over the long term for a company. But again, it's really important. Details do matter.
Ern says, I want you to analyze my portfolio and do have more insights. Ern, that would get into the financial, what am I thinking of? That would get into the financial recommendations system, and that's something that we aren't interested in. If you're interested in a private accounting lesson, send me a DM on Twitter, and perhaps we could talk. Raghu says, do you have purchasing power parity adjusted price for the course from participants in non-Western countries? I'll also say, Raghu, send me an email or send me a DM. That is perhaps something we can talk about. And during the course, Jen says, did you answer that one? Oh, you answered that one.
Yeah.
Sorry.
Let's see. Here we go. Anonymous says, do you also pay attention to ethics when you invest? For example, the environmental impact of a company, something like that could have a long-term impact on the success. That is a case-by-case basis. If you're asking, do I or do we take that into account? Yes, we do. However, what I would also just throw in there is that we have seen the ESG, which is environmental, social, and governance, be completely whitewashed. And what we mean by that is we think that the idea is very important, not just for the environment and communities, but for the long-term returns for shareholders. They're all tied together. At the same time, it's become one of those things where everybody has a glowing ESG report, and you just know that it's not accurately reflecting everything that's in there. That's what happens when there's not GAAP principles for how ESG things are reported.
Anonymous asks, what resource apps do you find useful to reviewing multiple years of financial statements? Stratosphere is my number one choice right now. So that's one I recommend and use myself. Giri asks, why would an acquiring company add goodwill in assets if they paid an extra amount? So that extra amount that they paid represents money that left their bank account to acquire something. They have to account for getting something in return for that money that they spent on the acquisition. The way that accountants deal with that problem is by recording it as a long-term asset that they just so happen to call goodwill. So remember, this is extra money that they spend to acquire something, and there has to be an accounting way for them to get something in return for that. So that's why they do it. Now think about this. When Facebook, Meta, bought Instagram, that was $1 billion acquisition. Largely, they had to record, I'm guessing, $900 million in goodwill or something like that in their balance sheet. Well, that business is probably worth $200 or $300 or $400 billion today. So in that case, that goodwill that they bought was a tremendous buy for the company. That's an extreme outlier, but it does show that in some cases, that goodwill actually has tremendous value.
But you being reticent about that being under assets, if that sets off your spidey senses, that's a good thing because it is a weird accounting rule. Question here from Stefan. What are our favorite valuation numbers? This we talk about in our valuation course, which is a completely separate thing. It depends on the stage of growth a company is in. In general, the two that I would look at our price to free cash flow, and then we have a reverse discounted cash flow model that we can use to look at what kind of growth is assumed in a stock's price. I find those to be the most useful personally.
Anonymous asks, will we have recordings of the class after the course completion? If you take the course, you get access to the replays within hours of them being available. You get transcripts, you get the materials, you get the homework, you get everything continuously throughout the course. And at the end of the course, we also bundle them together and provide that to you. So you can track along the course with us in real time if you choose to take it.
All right, since I think we've answered most of them, I do see that Avery, oh, well, real quick, Carl, Yes, I would absolutely suggest this prior to the valuation course. We did have some students take the valuation course first when we offered it the first time, and it was clear that those students would benefit if they didn't have a background in accounting from taking this first. So yes, but I since we've answered most of them, I just see that Avery, who is someone that I recognize from our time with the Motley Fool as well,
Yep.
asking some questions. So this is an interesting one. Did the pivot to profitability executed by Forrest Lee at Sea Limited blow your mind? Yes, it did blow my mind. What I'm waiting to see, however, Avery, is when you cut costs that fast, it makes everything look really good in the short term. But are they going to pay a price for that? Like, they cut out their advertising by like a ridiculous amount. That saves a lot of money. But now there's no ads running in Indonesia for Sea Limited. Is that going to have an effect on their sales moving forward? We will see.
Niraj says, where do you get to see how different business segments are doing in a company? That depends on the company. Some of them choose to give investors lots of information and they break out the business by segments. Others choose to purposely lump everything together and make it hard for investors to analyze. If that information isn't in the press release or the investor materials, it would be in this wonky section of SEC filings called Management's Discussion and Analysis of Financial Statements. That's where you would go to get that information if it was available nowhere else. But some companies just choose to keep things as oblique as possible.
Brian, Chad asked, what do these numbers that we've got here represent? You see mine is right here, 2046. Do you want to take this one?
Yes, that is the year that we turned 65. And that is a reminder to ourselves constantly to think and invest for the long term.
Shout out to a member at the Motley Fool who 3D printed these for the two of us so that we can show them live.
Right.
I don't see any.
Stefan says, where can I join the valuation course? Stefan, we have a wait list right now for the valuation course. What we essentially do is every other month, we do a live course and we do financial statements and then we do valuation. So that next valuation course will be done in July.
And
July.
Stefan, if you want to end up on that list, I'm just putting it. You can enter the wait list by putting your email in, and I put the link in the chat right now.
Yeah. Sid says, how do we measure depreciation in the real estate industry where we see almost only applications there? Yeah, the real estate industry is kind of its own beast in a way. That industry is heavily dependent on depreciation to knock down its net income as low as possible. And if you're going to be analyzing real estate companies, that is slightly more advanced than what we teach because you have to look at a metric called AFFO, funds from operations or adjusted funds from operations. That is akin to the profits, if you will, of companies. So with some industries, notably financial companies and real estate companies, there is some extra analysis that you have to do, but the core terms are exactly the same.
Yep. I see that we are at the top of the hour. I'll take one more. John says, Brian, you mentioned a couple times that you put a link or two in the chat, but I don't see them. Look in the chat button and not the Q&A. Also, because Brian Withers, our third Brian, you have to be named Brian to join our little group here. He is on vacation in Italy and he normally runs everything in the background. I'm doing it now. So if you see a link that showed up from Brian Withers with the little cartoon avatar, that is the link that I threw in there. So it is in the chat.
Also, everybody that's watching this will be given an email within a couple of hours of us being done here with a replay, with summary slides and links to everything that we talked about. So keep an eye out for that. But it is the top of the hour. We do hope that you enjoy. What?
Real quick, because Stefan is saying he can't find them too. I'm just going to share the link. If you go to the webpage, Maven, and you look up, you can see, and you type in Feroldi, you can see Valuation Explained Simply. If you type in Feroldi, now that's not the one that we're offering now, but you can also see our other course right here, Financial Statements Explained Simply, and that's where you can click to enroll.
Yep. Okay, cool. Well, thank you all so much for attending. We super appreciate your time and your attention. We absolutely love teaching people everything related to money, and we know that our course has helped hundreds of people. We expect and hope to get that to thousands of people over the next couple of years. So thank you all so much for your attention. You'll be getting an email with a replay of this and all the materials within a couple of hours at the end of this. So we hope you consider joining us in the course. Use the code webinar299 to get the biggest discount that we have, and we hope you consider it. Thanks so much for your time. Brian's out.